Quick heads up. This video is for educational purposes only and is not professional financial advice. Do your own research before investing. NVIDIA, ticker NVDA. A chip company now worth $4.66 trillion. Its revenue has grown over 700% in just 3 years. And right now, the stock is trading nearly 30% below our fair value estimate. So the question isn't whether NVIDIA matters, it's whether this price is an opportunity you can afford to ignore. NVIDIA started as a gaming graphics company. Today, it is the backbone of artificial intelligence. The same chips that once rendered video game worlds are now training the models powering everything from chatbots to drug discovery to autonomous vehicles. The business runs across 2 massive segments. The graphics division covers GeForce GPUs for gaming, cloud gaming through GeForce Now, professional workstation cards under the Quadro and RTX lines, and the Omniverse platform for 3D and virtual world creation. Then there is compute and networking, the engine of the AI revolution. This segment handles accelerated data center computing, Mellanox high-speed interconnects, autonomous driving systems, robotics through Jetson platforms, and enterprise AI software under the NVIDIA AI Enterprise umbrella. 36,000 employees, headquarters in Santa Clara, California. Founded in 1993 and public since 1999. NVIDIA sells through device manufacturers, cloud providers, system integrators, automotive companies, and retail channels across the United States, Taiwan, China, and markets worldwide. The numbers coming up will show you exactly how dominant this position has become. Over the past 255 trading days, NVIDIA has been anything but boring. The 52-week range runs from $151.49 all the way up to $236.54, a spread of over $85. The stock has seen a sharp rally, a significant pullback from those highs, and is currently sitting at $192.53, closer to the middle of that range than either extreme. The most recent close came in at $194.85, a 1.2% gain on the day. The 50-day moving average has remained above the 200-day moving average, a golden cross formation, which technically signals sustained bullish momentum. That structure tells you the longer-term trend is still intact, even as the stock digests its peak. The RSI points to neutral to moderately bullish momentum. The stock is not overbought. After pulling back roughly 18% from its 52-week high, the chart is offering a reset, not a breakdown. The revenue story here is historic. In fiscal 2023, NVIDIA posted $26.97 billion in revenue. By 2026, analysts project $215.94 billion. That is growth of over 700% across just 3 years. Not a startup. A company with a $4.5 trillion market cap scaling like one. But the real test of a business isn't revenue. It's what falls to the bottom line. Net income went from $4.37 billion in 2023 to a projected $120.07 billion in 2026. Earnings per share followed, 18 cents, then $1.21, $2.97, and heading to $4.93. Gross margin sits at 71.1%, operating margin at 60.4%, net margin at 55.6%. More than half of every dollar of revenue becomes profit. That is extraordinary for any business at this scale. Free cash flow tells the same story. $3.81 billion in 2023, $27.02 billion in 2024, $60.85 billion in 2025, and a projected $96.68 billion in 2026. The balance sheet is nearly debt-free. Debt to equity stands at just 0.07 times. The current ratio is 3.91 times. Highly liquid. Return on equity is 76.3%. The only honest weakness to flag is valuation, which we address next. Based on our discounted cash flow model, using a 10.0% discount rate and a terminal growth rate of 2.5%, our fair value estimate is $249.21 per share. The stock is currently trading at $192.53. That represents a margin of safety of 29.4%. The stock is moderately undervalued at today's price. Now look at the multiples. The current price-to-earnings ratio is 37.8 times earnings. That sounds elevated in isolation, but NVIDIA's own 5-year average price-to-earnings ratio is 59.7 times. Relative to its own history, the stock is cheap. Price to sales is 21.0 times. EV to EBITDA is 31.4 times. Price to free cash flow is 47.0 times. For context, these multiples are being applied to a business growing earnings by over 150% year over year. Here are the scenario outcomes. In the bear case, fair value is $211.83. In the base case, $249.21. In the bull case, $286.59. All three scenarios sit above the current price. That alignment is rare and meaningful. Every investment has risks. NVIDIA's are real and worth understanding. First, export controls and geopolitical exposure. A significant portion of NVIDIA's revenue flows through Taiwan and China. U.S. government restrictions on chip exports to China have already forced product redesigns. Any escalation could directly cut into data center revenue, the company's highest margin segment. Second, customer concentration. A handful of hyperscale cloud providers, think Microsoft or Google, Amazon, Meta, account for an outsized share of NVIDIA's data center orders. If even one major customer slows its AI capital spending, the revenue impact would be immediate and visible. Third, competitive pressure. AMD and Intel are both accelerating rival GPU architectures. Custom silicon from cloud companies, Amazon's Trainium, Google's TPUs, is designed specifically to reduce NVIDIA dependency. The moat is deep, but it is not unchallenged. Fourth, valuation compression risk. Even at 37.8 times earnings, any slowdown in growth expectations could reprice the stock sharply. High-growth premium multiples are fragile when sentiment shifts. On the catalyst side, the Blackwell GPU architecture ramp is already underway, with demand described by management as staggering. Data center AI build-out is accelerating globally, with sovereign AI investments adding a new demand layer beyond U.S. hyperscalers. NVIDIA's software ecosystem, CUDA AI Enterprise, creates recurring revenue that the market has not fully priced, and 76% of covering analysts rate it a buy, with continued earnings estimate revisions trending upward. The verdict is a buy. The bull case is straightforward. Blackwell demand is insatiable. AI capital expenditure is still in its early innings, and NVIDIA's software lock-in means pricing power compounds over time. Fair value $286.59. The bear case is real. export restrictions tighten further. Hyperscalers cut orders, and the multiple contracts, fair value $211.83. The base case lands at $249.21, nearly 30% above today's price of $192.53. A business growing at this speed, with these margins, this balance sheet, and this level of structural demand, trading at a discount to its own 5-year average multiple, is not a company you overlook. 76% of Wall Street agrees. The data makes the case. If you found this breakdown useful,